Houston leads U.S. population growth in 2025, and here's what that means for real estate and financing. And Houston has officially taken the top spot in the U.S. for population growth, adding over 126,000 new residents between 24 and 25. While growth has moderated slightly, the bigger story isn't the slowdown, it's the sustainability of the demand. And for borrowers, investors, and developers, this shift creates strategic opportunities if you understand how to position your financing correctly. So, population growth still drives real estate demand. And real estate follows one simple rule: you get more people, you build more housing, then you get more retail, and then you get more infrastructure. And even with a slowdown from 2.5 to 1.6% growth, Houston remains well above the national average. And that means continued housing demand pressure, sustained need for rental inventory, and expansion of retail corridors in suburban markets. And from a lending perspective, this translates into consistent deal flow across multiple asset classes. So let's talk about where the demand is shifting. And growth is not evenly distributed, it's moving outwards. So key suburban submarkets are seeing some real traction. So Northwest Houston, or Bear Creek in Copperfield, or Sugarland in Missouri City. And these areas are benefiting from a lower cost of living, new development pipelines for new homes, but also infrastructure expansion. So the simple translation for borrowers is that this is where lenders are most comfortable deploying capital. So let's talk about multifamily and build to rent and how they're leading the charge. And Houston's population growth is directly fueling rental demand. And some key trends to be on the lookout for is that multifamily absorption remains strong despite a new supply wave of inventory being delivered. But build-to-rent inventory has also more than doubled since 23. And homeownership barriers where rates and pricing are preventative are pushing renters to stay longer. And for mortgage strategy, this creates opportunities in DSCR loans for investors or bridge loans for value-add multifamily and construction financing for BTR communities. Let's talk about the financing angle that most people miss. And most people look at population growth and think, oh yeah, prices are going to go up. But that's a little incomplete. And smart borrowers can ask, how do I structure debt to capture some of that demand? And that is where strategy matters. So let's give you some examples. Locking in long-term fixed debt before further rate volatility and its strategy sessions involved, but using bridge loans to reposition assets in growth quarters, and structuring cash out refinances to recycle your capital. And structure beats rate, especially in growth market transitioning into normalization. So let's talk about why the slowdown actually matters. And Houston is basically shifting from hyper growth just to normalized growth. And what that does is that changes the playbook a little bit. You've got an old strategy and a new strategy. Buy anything in the path of growth and be selective in submarkets, but also rely on rent growth, focus on operational improvements, and aggressive leverage, but also smart, flexible capital stacks. And these are easy wins, but the easy ones are getting harder to find, and the bigger wins are the ones you prepare for. So what lenders are watching right now, and lenders are adjusting their underwriting based on migration trends. So domestic versus international and total outflows or inflows, rent growth versus the supply pipeline, but also on borrowers' liquidity and reserves and the exit strategy's viability. And that means, in English, that deals still get done, but only if they're structured correctly from day one. The bottom line is that Houston remains one of the strongest growth markets in the US, but we're entering a more disciplined phase right now. And population growth is going to equal sustained demand, and suburban expansion equals a targeted opportunity, and rental demand is good for financing tailwinds. And the borrowers and investors who win in this cycle won't chase growth, they'll structure around it. And that, my friends, is it for the day. I'd love to talk to you more about your situation, how we can improve your world. Please visit BillRapp.online.com to figure out how to get a hold of me. Love to talk more. Have a good day.